Hey, what is going on, guys? My name is Nick, and in this video we're going to be talking about the top 5 future-proof Vanguard ETFs to buy and hold for the long term, and then at the end of the video I'll be giving you my opinion on the best one to buy. And I just wanted to say the reason that I haven't been posting over the last few weeks is because I've been incredibly sick with something affecting my inner ear, which basically caused a whole bunch of dizziness to the point where I could barely even move without having the urge to throw up. So I really do appreciate your guys' patience and your kind thoughts over on my community post that I made, but I am finally recovering and I'm super excited to pump out some great content for you guys coming soon. Now for this video, I picked 5 Vanguard ETFs that track a bunch of companies in specific industries that will basically always be in demand, meaning that there will always be growing revenues generated by the companies within these ETFs. So by taking this more passive approach to investing, you won't have to worry about trying to sell out at the perfect moment or trying to time the market whatsoever, or even have to worry about when the economy goes to shambles like we've seen lately. Because as we all know, time in the market almost always beats timing the market. Not only this, but Vanguard is very well known for its low management expense ratios, which means you're going to be paying a lot less in fees when compared to a mutual fund or another type of ETF. But anyways, if you do enjoy this video, make sure to drop a like down below, as it does really help support my channel. And as always, if you haven't already, definitely consider subscribing down below for more weekly investing content just like this. So with that said, let's jump right into these future-proof Vanguard ETFs. Alrighty guys, now the first ETF that we have here on the plate today is one that's been extremely relevant over the past few months, and that is the Vanguard Healthcare ETF with ticker symbol VHT. Now this ETF allows you to invest in a broad exposure of 386 stocks within the healthcare industry, where the top 3 sectors under this big healthcare umbrella are in the pharmaceutical sector at about 30%, healthcare equipment at about 22.5%, and then finally biotechnology at 18.5%. And of course, this ETF does hold many of the bigger names that you've heard of in the sector, such as Johnson & Johnson, United Health Group, and Pfizer. Now in terms of the risk exposure that you're going to be taking on with this ETF, Vanguard has ranked this one as the highest risk reward potential, and that could be due to the high exposure to biotechnology companies, which are known to be very volatile, but also just the fact that there's a lot of healthcare regulation that could impact the fund's performance over time. But as we can see, over the past 10 years, these factors really haven't hindered the fund's performance, as it has achieved a compounded annual growth rate of 16.1%. And contrasting this over the past 5 years, we find that they had a compounded annual growth rate of 8.7%, which is still pretty good all things considered. But not only does VHT see a lot of capital appreciation, they do actually pay a dividend too, which is known as a distribution for an ETF. And what we can find is that the current distribution yield for VHT is sitting at about 2.2%, which is average for a broad market ETF. And I would argue that this distribution yield is very safe because healthcare is an essential sector and it should always be in demand. And finally, I also like to look at the fees associated with buying into an ETF, and for VHT right now, that's sitting at an MER, or a management expense ratio, of 0.1%. And like I said earlier, Vanguard does typically have these lower management expense ratios when compared to other funds that are typically sitting at 1.24%. So giving you guys my overall thoughts on this ETF, I personally feel that it's a pretty safe play because healthcare is always going to be in demand. People will always get sick, people will always need medication, and there's always a growing demand for medical equipment in hospitals and other healthcare facilities. And with the performance over the past 10 years essentially beating that of the S&P 500, I would say this is a pretty good play. Alright, now getting into Vanguard ETF number 2, and one that has essentially beat every other sector over the past few years, that has got to be the Vanguard Information Technology ETF, ticker symbol VGT. Now investing in VGT offers a broad exposure to 334 stocks within the information technology sector. However, that is a little bit misleading because what we find is that about 60% of the ETF is actually made up by the top 10 companies within that ETF, and those are huge companies, well-known companies like Apple, Microsoft, Visa, MasterCard, and so on. So because ETFs are typically a weighted average based on the company's market capitalization, these top 10 companies are going to have the biggest impact on the ETF's performance. Now Vanguard does rank this ETF at the highest risk reward potential, and that does make sense because these are growth companies with higher valuations, and that means they can get hit harder during recessionary periods. But ironically, as we've seen lately with the whole market issue, technology companies have actually held up the best amongst many different industries. And I do believe a big part of that is because of the strength in these companies' balance sheets, because of their low expenses and overall being being able to handle short-term losses. Now, getting into the performance, we find that VGT has done nothing but thrive over the past 10 years, having a compounded annual growth rate of 18.7%. And then just to top that, over the past 5 years, it's been sitting at 20.4%, showing that technology is only continuing to grow. But of course, when you're buying these high growth companies, you're not going to expect a high distribution yield because these companies are investing so much more back into their businesses. And what we find is that the distribution yield on this ETF, VGT, is sitting at 1.1%. And to me, guys, that's totally fine because the reason that I would be investing in this ETF is for the capital gains primarily. And finally, the second part of the equation is the fees. So we have to look at the management expense ratio, and that is sitting at 0.1%. So overall, my thoughts are that this is a great high growth ETF for those interested in the technology industry and see a lot of future growth potential. But although this ETF has been far outperforming the broader market indices over the past few years, it is trading at a pretty high valuation, so I wouldn't flood all of my money into it right away. I would probably follow a dollar cost averaging approach. Alrighty, now the third Vanguard ETF that we have on the list today is of course another one that's future proof, and that is the Vanguard Consumer Staples ETF, ticker symbol VDC. Now, interestingly enough, this ETF only tracks 94 stocks within the market in the consumer staples sector, where the top 10 stocks actually make up 65% of the ETF value. And of course, because this is a consumer staples ETF, you're going to be finding a lot of those bigger names that are probably never going to go bankrupt, like Procter & Gamble, Coca-Cola, PepsiCo, etc. Now, in terms of risk exposure, Vanguard ranks this as high, and I would personally disagree with this. The reason why they may have done this is because there's only 94 stocks in this ETF, but in my opinion, many of these companies are totally safe, and I would rank this as a pretty low risk, especially considering that the consumer staples sector is very steady during recessions because their products are continually needed. But because these companies in the ETF are generally more boring in nature and don't have too many growth levers to propel themselves like information technology companies, over the past 10 years, the growth has been a little bit lower at 11.5% per year. And then that actually drops down to 6.3% per year on a compounded annual basis over the past 5 years. However, on the other hand, this ETF does have a higher distribution yield sitting at 3.1%, which would be above average in terms of other ETFs. So while this yield does beat putting your money in a high interest savings account, I would say it's pretty good, but nothing special by any means. And then just like the other ETFs that we discussed, the management expense ratio on VDC ends up being 0.1%, so extremely low. So giving you guys my overall thoughts, we can see that up until a few years ago, the consumer staples ETF has been following the S&P 500 performance pretty closely, but then lately it has been underperforming. And this could mean that it's offering some better value when compared to history, so I would probably be a buyer because the consumer staples sector is always going to be in demand. All right, now the fourth Vanguard ETF that we have on the list today is the Vanguard Utilities ETF with ticker symbol VPU. Now this ETF is not as well diversified when compared to many of the other ETFs because it only holds about 67 stocks in the utilities sector. And we do find that it's pretty narrowly focused on the electric utilities, where about 60% of the stocks are held in that sector. And then we have the multi-utilities at 30% and then gas at about 5%. And again, Vanguard ranks this as a high risk reward level, and I would personally totally disagree with this because the utilities sector is so solid in all economic conditions. Not only that, but the risk is pretty low because many of the companies within this ETF are dividend aristocrats and dividend kings, meaning they've been able to continuously pay and increase those dividends year after year for 25 or 50 years respectively. And for this reason, we find that the distribution yield on this ETF is quite a lot higher than many of the others we discussed, sitting at 3.8%. And the reason that there is a higher distribution yield than many other ETFs is because utility companies are notoriously paying out dividends because they can't produce a lot of capital gains when they invest a lot back into their business models, so they're typically slower growers. However, over the past 10 years, VPU has actually had a pretty good performance record, with their compounded annual growth rate sitting at just under 12%. And then over the past 5 years, it's been about 10% per year, which is just below the S&P 500 level. And again, we do find that management expense ratio to be really low at 0.1%. This must be the magic number for Vanguard. Who knows, but overall, this is a pretty solid ETF with a lot of safety. And guys, if you think of it this way, there will always be a demand for electricity, water, and natural gas, so there's nothing really to worry about in terms of the future growth of this ETF. And not to mention the dividend yield sitting at 3.8%, this is a pretty solid yield for passive investing. All right, and last but not least, we do have the final future-proof ETF, and that is the Vanguard Real Estate ETF with ticker symbol VNQ. Now, unlike many of the other ETFs that we discussed, this real estate ETF is very well diversified across the real estate sector. VNQ tracks 183 companies that do include healthcare REITs, industrial REITs, specialized REITs, real estate development companies, and so many more. And then some of the largest companies in this ETF are just some massive REITs across the US, which are the American Tower Corporation, Crown Castle International Corporation, and Prologis. Now, in terms of risk exposure, Vanguard ranked this ETF at a medium risk reward level, which I would tend to agree with. Real estate is a sector that will always be in demand, and because many of these REITs have long-term triple net contracts with their tenants, the cash flow is very steady. But as we've seen lately with the whole global situation, retail REITs really haven't been doing that well, and there is a little bit of risk in that sector. Now, if we take a look at the past performance, we find that this fund really isn't held up as well as some of the other ETFs we discussed, with the compounded annual growth rate over the past 10 years only being 8.9%. And then even worse, over the past 5 years, it's been sitting at 3.3%, which is pretty bad in my opinion. However, I think this huge underperformance over the past few years is mainly due to the recent market crash, and it should get better from here on. Now, it is important to realize that the majority of the gains are probably not going to be coming from capital gains in terms of REITs and real estate companies. It's going to be generated from rental cash flow, and that is why the distribution yield is so high at 4.4%. Obviously, this is the largest distribution yield out of all the ETFs we discussed, and that is because REITs are required by the SEC to pay out 90% of their net income to shareholders in the form of these distributions. And if you are interested to learn a little bit more about REITs and how they operate, definitely check out my video above here. And finally, we do find that the management expense ratio for VNQ is sitting at 0.12%, which is 20% higher than the other ETFs, but really it's pretty insignificant. And if we compare this to the average of other funds out there, which are typically sitting at 1.19%, this is very insignificant. And giving you guys my overall thoughts on this ETF, we do find that it has been underperforming the S&P 500 over the past few years, and actually the past 10 years, but this could really mean it's showing some value, especially considering the recent stock price drops in retail REITs. And it's important to realize that real estate will always be an industry that is in demand because everyone needs a place to live. Alrighty, now for the part you have all been waiting for, which of these Vanguard ETFs is my top pick of the bunch? Well, this may surprise some of you, but I would have to pick the Vanguard Information Technology ETF with ticker symbol VGT. Out of all the ETFs that I presented in this video, VGT has by far had the best performance and has outperformed the S&P 500 by basically double over the past 10 years. And if we dig a little bit deeper, we do find that the fund is trading at a pretty high PE ratio of 28. However, this is pricing in an earnings growth rate of 18.7% per year, which is astronomical, so that does deserve the valuation. Not only this, but the median market capitalization of the companies within this ETF is sitting at $200 billion, which is very high and safe for most investors. And we generally find that technology companies have some of the best balance sheets out there, so it really doesn't concern me over the next recession that it will drop significantly. So for those reasons, I would be picking VGT as my #1 Vanguard ETF to buy out of those discussed today. But guys, do let me know down below what is your favorite, and if there is another one that I didn't discuss in this list today that you do think is future-proof. So anyways, if you did enjoy this video, make sure to destroy that like button for me. It really helps out my channel, and this video took a lot of time and effort. Also, if you haven't already, definitely consider subscribing and hitting that bell icon down below so you don't miss my weekly investing videos just like this. And with that said, I will see you guys in the next one.